Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, February 17th, 2024. I hope you are doing well, having a good weekend. I appreciate you coming and spending your time with me to watch this weekend's trading review. I am recording this today from Santa Marta, Colombia, beautiful Santa Marta, Colombia. I have been here for, I guess, about a month and a half, and I think I'm going to stay a little longer. Maybe another couple weeks, maybe another couple months. I'm not sure. I really like it here. Just beautiful. Here's a picture that I took last night on the beach. Just really beautiful place. By the way, just wanted to show you, this is a picture of my girlfriend and I on the beach. That's my beautiful girlfriend, Christina there, and that me with the beard. I guess that's me looking pretty old. But anyway, the format for today, what we're going to do is first of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the positions that I have, all the trades that I made last week, both on the daily time frame and on the weekly time frame. We're going to talk about when I entered the trade, why I entered the trade, which are the strategies that I was using on that particular trade, and why I am entering. We're going to talk about where my emergency stop is. We're going to talk about where my end of day stop is. We're going to talk about, if it moves my way, how I am going to handle the trade. It's very important in trading that you have a complete process of looking for some kind of rejection of a level, positioning correctly based upon the volatility of the market, placing that emergency stop, having a good risk to reward ratio, taking partial profits each day if it moves. Well, for me, if it moves my way, I take partial profits, knowing where significant overhead resistance levels are, but basically having a process instead of just making emotional, impulsive decisions based upon how you're feeling at that second. You're always going to be a better trader if you have a good process based upon good trading principles. So we'll take a look at the positions, both on the daily time frame, weekly time frame, and how I'm managing those positions. After that, we're going to talk a little bit about trader psychology. Always the most important part of trading, or the most important skill in trading, I should say, is the ability to, again, create a good plan. It doesn't have to be a complex plan, but to follow the plan. And that comes down to trader psychology. And so it's always helpful for me to teach this. And so I hope it's helpful for you. So we'll spend some time on that. After that, I have gone down through my master watch list, both on the daily time frame and on the weekly time frame. And I have identified some potential trades for next week that, if these markets get to the levels that I'm looking for, then I will consider taking them. Doesn't mean I have to, but if I have a good confluence of signals, they get to my levels, the price action is correct, I have a good risk to reward ratio, then I will consider them. So I think I have 11 on the daily, 4 or 5 on the weekly of what I will be looking for next week. So, all right, so that's the plan for today. Let's get this U.S. legal disclaimer out of the way, and I will be back in about 42 seconds. So hang tight. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
Okay, here we go. Let's start out with UNG. I don't have a lot of positions on the daily. I did exit majority of mine last week, but this is UNH, and I did enter UNH here on the 1st of February. Why did I enter it here? Well, take a look at the black line here. This is the 200-day moving average. This is a major moving average that a lot of large financial institutions and experienced investors kind of key their trades off of. This is a level. You hear in trading about levels. This is a key level, and I want to see a rejection of a key level. So on the day that I bought it here, the 1st of February, why did I buy it? During the day, it came down, basically just touched the 200-day moving average, and then closed above it. Right when it got to the 200-day moving average, buyers came in. And that is a good piece of information to have because it means there were no more sellers underneath this level. So I did buy here on the 1st of February at 506.56. Now, as soon as I take a look at the signal and identify the signal, the first thing I do is I have to decide how many shares I'm going to buy, and I have to base my purchase based upon the current market volatility. I do that by using the ATR, the average true range of 2, which right at the moment is 1956. So how many shares I buy depends on what the average true range is and how much I have in my trading account. So for today's purposes, let's just start with the hypothetical $100,000 trading account. $100,000 trading account, I times that by 1%, that's $1,000. If I had a $50,000 trading account, 1% would be $500,000. If I had $1 million trading account, 1% would be 2,000. Okay, or 10,000. So let's just use 1% of a hypothetical $100,000 trading account. I take 1,000. I divide it by the value of the 2 ATR. The value currently of the 2 ATR is 1956 divided by 1956. That would tell me to buy exactly 51 shares. Okay, so that's 1% of my total trading capital divided by the value of the 2 ATR tells me to buy 51 shares. So the next step, as soon as I buy 51 shares here, and if you had a $200,000 trading account, it would be double this. First thing I do is I place my emergency stop exactly the value of the 2 ATR 1956 below my entry. Okay, so if the market ever in the future ever got down to this level, I would know exactly how much I would lose. This is 2 ATRs away from your entry. Shouldn't get down here. It only gets down there about you hit your emergency stop only about 5% of the time. 95% of the time, your end of day stop is going to come into play. And why did I take the trade in the first place? I took the trade in the first place because it rejected the black line. It rejected the 200-day moving average. Therefore, in the future, if it closes below the 200-day moving average, I'm simply going to get out for a smaller loss. I know what my emergency stop is. That's 1%. Right? But this is really the correct way, in my opinion, to position size. Position sizing is so important, everyone. And you have to know what your worst case scenario is going to be. But the way that I do it, I have an emergency stop 5% of the time. That may hit 95% of the time. If it just closes even 1 penny under that 200-day moving average, I am simply out of the trade for a small loss. And that is the secret to trading. Looking for a rejection of a major level like I did here with the 200-day moving average. And if it closes below that level, if there are not enough buyers to keep it above that level, I simply get out. Okay, so bounce at the 200-day moving average, position size correctly, place my emergency stop 2 ATRs below, and my end of day stop is simply a close below the 200-day moving average. So everything I've talked about here, first of all, has been defensive. Position sizing correctly, emergency stop, end of day stop. When are we going to talk about profits? All right, we'll talk about profits right now. So as soon as I buy this and I know where my end of day stop is, I know where my emergency stop is, I always place a line 1.5 ATRs above my entry. Once I get to this level, then I am going to tighten up my stop. Okay, so now once I place my 1.5 ATRs above, now I am going to get out of a portion of my position if it moves up the value of 0.45 ATRs. Right now it's $4.44 from the previous day's close. So I'm in this position right now Look, 521.55 is the current price of the stock. I'm still in the stock. So I take the closing price, 521.55. I add the value of the 0.45 to it, plus 4.4. My first profit target on Monday will be 525.95. And how much will I sell there? Just 10% of whatever shares that I had going into the day. So that's my first profit target. My second profit target is I'm just going to take my first profit target, add the value of the 0.45 to it again, plus 4.4. My second profit target on Monday is going to be 530. And if it gets there, I'll sell another 10% of the remaining shares that I had going into that day. And the third profit target's the same. Take the second profit target, add 440 to it again. And so my third profit target for Monday will be 534.75. All right, so that's how I take partial profits. I take the closing price of the day, add the value of the 0.45 to it 3 times, and those are my 3 profit targets for the day. And 10%, I would exit 10% of my shares at each profit target. So let's start over. Bounce at the 200 is why I took the trade. Okay, position size. Place my emergency stop 2 ATRs below. My end of day stops a close below the 200-day moving average. I place my 1.5 ATR trailing stop level. So if we get up there now, I go into trailing stop mode. And of course, I always take partial profits if it moves my way. So I bought it here at the first. 506.56. Next day it moved up. It moved up enough for me to take 10% off. It moved the value of 0.45 ATR. Next day came down, but held the 200-day moving average, so I did not get out of the trade. Had it closed below the 200, I simply would have been out for a very small loss. Next day moves up, I take some more profits off the table. Next day moves up, I take some more profits off the table. Then it doesn't move up, it just kind of consolidates until here on the 13th, where it opened up higher, went up much, much higher, thankfully, because I took another profit target off. And it also did get to trailing stop level, which means that in the future now, if I have a close below a previous bar's low, I am simply going to get out of the trade. Well, since it has reached trailing stop level, but has not closed below a previous bar's low, I'm still fully in the trade. Now, going forward, if we continue to move up, I will continue to take profit targets. If we get to a 65 RSI or higher, right now we're at 53.72, then I will go, then the 5 EMA will come into play. This is this thin blue line right here. And so if I get to 65 RSI level and then have a close below that, I'm completely out of the trade. Alternatively, if it continues to move up and I reject the 70 RSI, then I'll get out of half. And then I'll get out of the remaining half if I then get a close below a previous bar's low after rejecting the 70 RSI. So I know this all may sound a little complicated to you if you're new to the channel, but it's really not. You know, I've been trading for over 28 years and I've developed this strategy by being a student of many famous traders, and I've combined this all into my approach. And by the way, I do teach private one-on-one lessons in the evening time via Skype. I teach my one-on-one students exactly how I trade. It's a 15-hour one-on-one course, 5 sessions. Each session is 3 hours. So, you know, if you're interested in working with me, if you're interested in taking this course one-on-one with me, I'd love to have you as a student. My email is in the link of this YouTube video. The course is $1,750, but worth every penny. So if that's of interest to you, just email me and we can get it started. And I'll talk a little bit more as we get at the end of the podcast. But this particular trade doing well so far. Remaining shares from entry to exit up 2.87%. Pretty good. Apple. Okay, so I did get out of Apple on Friday, yesterday, for a loss. But what I want to show you here, obviously, is why I took the trade. Why did I take the trade? Well, I took the trade here on the 15th because during the day we went below the 200-day moving average and then closed back above it. That's called an intraday rejection of the 200-day moving average. Also, the day before, it also tested the waters under the 200 and then closed back above. So 2 days closing back above the 200 did give me some confidence that that 200 was going to hold as support, but it did not. I have a lot of losing trades, but the key is your losing trades should be small, and most likely you're going to be out quick. Look, I was in the trade for one day, right? Thursday, I bought at 183.64. Friday, yesterday, I got out. Oh, here, I didn't mark the chart. Right here at about 182.10 for a small loss of 0.86%. It's fine. You're going to have losses. If it comes back over the 200-day moving average, I could just simply get in again. But you'll see with my trades, if I'm in a trade for a long time, it means that I am most likely positive on the trade. If I have a losing trade, I'm almost out. I'm out very quickly, just like with this Apple trade. I enter on Thursday, out on Friday because I am wrong. But if I'm in a trade for a long time, it means that I'm most likely positive because I have a process. Again, at the beginning of the podcast, I talked about having a process. So when I'm wrong, out quickly. I always say this each podcast. You have to be very patient with your winners, and you have to be very impatient with your losers. That's what it comes down to. Being impatient with your losers, getting out quickly, staying in your winning trades, and being patient with them. And again, having that process that tells you whether you should be patient or impatient. So Apple, 1 day quick loss for a loss of 0.86%. So real quick recap, I just always recap these on the daily here. Current shares left on UNH up 2.87. And then Friday closed out Apple for a loss of 0.86%. Let's go over to the weekly bars. Now the weeklies, of course, each bar is a week. I take these trades on Fridays because that is when the weekly bar closed. And I have been in this trade for almost a year. So do you think that I'm positive on the trade or negative? Of course, positive. If I'm in the trade for a year, I'm not going to hold on to a losing trade for a year. I can assure you that. Let's look at XLF. I bought this all the way back here on the 24th of March, 2023. Why? Well, purple line here. This is the 250-week moving average. This is a key level. So that week we came down, we touched the 250-week, closed back above. So I got long here, 30.71. I position size, as I mentioned earlier in the podcast. I placed my emergency stop 2 ATRs below. My end of week stop is where why did I take the trade in the first place? Because it rejected the 250. Therefore, if it closed below the 250, I would simply be out of the trade. I placed my 1.5 ATR trailing stop above my entry. The next week it moved up, took some profits off with the partial profit strategy. Next week, nothing. Next week moved up again, took more partial profits, and I got into trailing stop mode. Now that means if I have a close below a previous bar's low, I'm going to get out of half. Never quite happened. Then we moved up again. And then here on the 23rd of June was the first close below a previous bar's low after reaching trailing stop level. I sold half of my remaining shares for a gain of 6.4%. Then we had another month and a half of upwards movements where I kept taking profits off the table, off the table, off the table. Then we moved down for about a month, sideways for about a month. Then for about a month and a half, we moved down. Here on the 27th of October, that week poked its head below the 250-week moving average, but then closed above. Had it closed below, I simply would have gotten out, but it closing back above the 250-week moving average kept me in the trade. And then for 3 months, we have just gone up and up and up and up and up. So on these big bars, I took some profits, took some profits, took some profits, took some profits. Profit this week as well. And right now we are at 75.55 RSI. Extremely overbought, I can tell you that. But I know I have a plan. I have a process. Here's the 5 EMA, weekly 5 EMA. If we close below that, I'm just simply out of the trade. That's it. I will be done with the trade. If it just keeps moving up, I'll just continue to take partial profits off and off and off. But this trade has been a monster, and not all trades are like this. But if you trade long enough and you have a process to stay in, you will get these kind of trades. This trade is up 22.52%. All right, let's go to Johnson & Johnson, J&J on the weekly as well. Oops, sorry about that. Here we go. Johnson & Johnson. All right. I did buy J&J all the way back here on the 15th of December of last year. Why did I buy it? Well, I bought it here at 154.27. Why? Well, the week that I bought it, during the week, we went below the 200-week moving average, close back above it. Okay, that's my main signal. My supporting signal is we have a V1 entry signal. A V1 consists of two bars, bar 1, bar 2. Bar 2 goes below bar 1's low and then closes above bar 1's close. This is a V1, so I had a confluence of signals, a rejection of the 200-week moving average and a V1 entered here, 154.27. And by the way, if you'd like to learn more about V1s or V2s, go to my YouTube channel. In the lessons playlist, I have a video there that I created that talks about V1s, V2s, what they're about, how I use them, but they're a big part of my trading, really the bread and butter of my trading. And so I got long here, 154.27. My end of week stop is simply a close below the 200-week moving average. My emergency stop, of course, is 2 ATRs down below. I placed my 1.5 ATR trailing stop level above. Oh, we had a dividend, so this messed this up. Well, anyway, yeah, we had a dividend, so that's why these things changed around. But so moved up the next week, but not enough for a profit target. Moved up the next week, not enough for a profit target. The next week moved up strongly, did take some profits off the board. The next week did get to trailing stop level. Now I'm in trailing stop mode, which means that if I have a close below previous bar's low, I get out of half. That did happen back here on the 26th of January, where I took half the position off for a, I can't read that, 3.33% gain, which is good. Then we've moved back for the next 3 weeks. We're consolidating here, but we still are above the 200-week moving average, so I am still in the trade. The remaining shares on J&J that I have up 1.52%. And then U, which is Unity Software, really like this approach. This one is barely up, but this is a really great strategy that I use called return to value V1 or V2. The green line here, the green line here, anywhere in between these two green lines is considered the value zone. I don't like to buy above the value zone. I like to buy in the value zone and sell above the value zone, or buy below the value zone and sell in the value zone. But this is a textbook perfect setup of a return to value, in this case V2, where first of all you have to be above the value zone. Secondly, you have to come back in the value zone. Third, you need some sideways motion. Definitely have that, right? Above the value zone, came into the value zone, sideways motion. Perfect. Absolutely perfect. But then to enter the trade, you need a signal. The signal is a V2 in this case. A V2 consists of 3 bars. Bar 1, bar 2, bar 3. Bar 2 goes below bar 1's low. Bar 3 closes above bar 1's close. I got in long here 33.41. Currently it's 33.90. My end of week stop on a return to value V1, V2 is halfway of the washout bar, which is here. You can see the green line here. From a Fibonacci standpoint, this 50% should hold. If it closes below halfway of this line, I would simply get out. You see my emergency stop down here. My 1.5 ATR trailing stop level up here has not reached it, but it has not closed below halfway of the washout bar, so I am still in the trade. This trade up a little, not a lot, up 1.39%. So just to review on the weeklies, XLF up a whopping 22.52%. Johnson & Johnson up 1.52%, and Unity Software up 1.39%. So I've really pared my positions back. You know, I had 8, 9, 10 positions, but a week ago and the week before that, I had a lot of exit signals. And I follow the signals. Once they tell me to get out, I just get out, and then I wait for another trade that has a better risk to reward ratio. So hopefully that was helpful, everyone, to take a look at those particular trades, even though there weren't a lot of them. So let's talk a little bit about trader psychology, and then we will move on to the trades that I am looking for next week. All right, let's talk a little bit about trader psychology. This is from my very good friend, Stephen Burns. He's one of my coaches, great author, great trader. You can visit him at @sjosephburns over on Twitter. Let's see what Steve has to say today. Your ideal position size will help you follow your trading plan. Listen, position sizing is one of the most important things in trading. If you have too small of a position, you're not going to make any money. If you have too large of a position, you're probably not going to be able to stick in there with your process. So he has a great chart here, performance correlated with stress and anxiety. So if your position size is too low, boredom, depression, yeah, of course, if you buy one share of something, you're probably not going to spend too much time monitoring it, but you're probably going to follow your process perfectly because there's no stress on the trade. Your position size is so small that you're really not going to have any stress about it. Too low of stress is not going to make you any money. Too high of stress is going to make it so that you do not follow your position. We need to find that sweet spot where you're paying attention to the trade, but you're still calm enough to follow your process. As your trading size increases, your attention increases, but you have to find that ideal spot here. If it's too large, then you're going to have a lot of anxiety. You're probably not going to stay in the position even though your process is telling you to. And then if it's really high, you're just not going to make good decisions. So what I told you about earlier, that I use 1% of my total trading capital divided by the value of the 2 ATR is just about perfect, because I know in the worst case scenario where my emergency stop is going to be and I'm going to lose 1%. But like I said, that only happens about 5% of the time. 95% of the time, I am just going to get out with a much smaller loss below my end of day stop. But if someone told me or asked me, listen, what's the most important thing in trading, like the number one most important, is it the setup? What is it? It's position size. It really is position size. And that's why what I explained to you earlier with my position size, it works for me. It doesn't mean it's the best one in the world, but it works for me and it really makes sense. So whether you're learning from me or learning from someone else, make sure that you have a formula where you position size, keeping in mind the market volatility, keeping in mind how much money you have, what the implied volatility on each move is going to be. If you lose all your money, you're out of the game. You're out of trading. The only way to get better at trading is to stay in the game so you get more experience. And the way to do that is to position size correctly and find a position size that's right here in the middle of the sweet spot where you can make money. There's still risk, but it's enough for you to follow your process. I talk about this every podcast, getting a process, finding a process. A process is not just where to enter, it's where to enter, how much to enter, where the emergency stop, where the end of day stop is, scaling out, getting to significant resistance levels, and knowing what to do with it. And again, this is what I teach in my one-on-one course. So again, if you're interested, please contact me. But your ideal position size will help you follow your trading plan. If you follow your trading plan, if it's a decent trading plan, your results are going to be the best. And really, that's what it comes down to. So what it really comes down to is finding your ideal position size so that you can follow your process. So thank you very much, Steve Burns. Appreciate that. You can follow Steve Burns at @sjosephburns over on Twitter. All right, let's get back to the potential trades that I am looking for next week. Now, keep in mind that here on the dailies, I have potential of 11 signals for next week. Now, theoretically, these could all trigger on the exact same day. Does that mean that I would enter all 11 of them? No. I have a rule where I only pick the best trade of the day. Even if I have 10 or 11 that trigger, I need to select the best one. And how do you do that? Well, it comes with experience, but it really comes down to which one has the best risk to reward ratio, which one has the most confluences or combinations of indicators or entry signals happening at the same time. Which one had the best market strength relativity of that particular market compared to the rest of the market? Which one looked the best on the higher time frame? Right? This is how you're basically giving it like a report card. Okay, we have 10 of them that triggered, but this one had the most signals, the most confluences, the best risk to reward ratio. It looked best on multiple time frames. That's how you narrow it down to the best one. And again, in my one-on-one course, this is what I teach, how to do that as well. So let's start. Let's go with Apple. Okay, as I mentioned, I am out of Apple on Friday because it closed below the 200-day moving average. But it doesn't mean I'm done with Apple. I have two options here. The stock either has to move up or it has to move down from here. If it moves up and closes back above the 200-day moving average, I may consider getting an Apple again. If it continues down, then I need to look for a different level. Well, what would that different level be? Could be down here at the 250-day moving average. That would be a key level to base and structure my trade off of. It could move down to a 30 RSI level. I would buy Apple at a 30 RSI level for sure if it rejected that. Or ideally, and right here, if we look at this 250-week moving average here, if we do get down to the 250 moving average, we'll probably get down to the low 30s or reject the 30 RSI as well. That would be a confluence. And a confluence of a rejection of the 250-day moving average and a rejection of the 30 RSI level would be an excellent place to enter Apple. It doesn't mean it's going to be a winning trade, but it means that it's a great level with a good risk to reward ratio. And that's about all you can ask for. So Apple, two potentials here. If we move up above the 200-day moving average, the black line, I'll consider entering it. If we move lower and reject the 250, I would consider entering position. If it rejects the 30 RSI, I would consider entering there as well. So it just needs to move higher above the 200 or lower down to the 250 or the 30 RSI. Boeing. Okay, so Boeing is setting up for a potentially really good signal here. You can see over the last 4 days we've moved sideways. So what does sideways motion means? It means there's equilibrium of buyers and sellers at that point. It's not going higher, it's going lower. So it's a real battle between buyers and sellers, and that's why it is moving sideways. But there's one thing in trading for sure. Sideways motion will then lead to a trend. Which direction it's going to lead, I don't know. This sideways motion could lead to a trend up, or this sideways motion could lead to a new trend down. But remember that sideways motion will always lead to a trend. So right now, what I am looking for next week is a V1 or a V2 entry signal to the upside. We closed below the value zone. We've come into the value zone. We've pulled back. Again, this is what I teach in my one-on-one course. This is called a higher low V1 or V2. I mentioned earlier return to value V1, V2, but this is kind of the opposite of that. But nonetheless, what I'm looking for next week would be a V1 or a V2. For instance, on Monday, we come down, go below Friday's low, close back above Friday's close. That would be a V1. Or Monday comes down, but doesn't close above Friday's close. And then Tuesday, for instance, it moves up and closes above Friday's close. That would be a V2. Remember, V1s consist of 2 bars, V2s consist of 3 bars. MACD is green, which I really like, and we are in the value zone. So again, the sideways motion is going to lead one way or the other. I just don't know which way it's going to lead, but if I get a V1 or a V2, a V1 or a V2 is signaling that you tried to go down but reverse back up, so it gives you the edge that the move is going to be towards to the upside. But I don't know that's going to happen. I just have to wait for that to happen. Okay, so Boeing V1 or V2 next week has to close in the value zone. Bitcoin. Okay, So I want to kind of highlight a video that I have on my channel called Abandoned Babies and Island Reversals. It's a really good video. It talks about abandoned babies, island reversals, some of my new favorite entry signals. An island reversal is when you have a gap up, as we've gapped up here, some sideways motion of more than one bar, and then a gap down. If we have a gap down, say, for instance, on Monday, it leaves a gap going up and a gap going down, then that would be an island reversal bar. Island reversals, abandoned babies, are some of the best formations that signal short-term or long-term tops or bottoms. So what I'm looking for next week is a gap down. If it doesn't gap down, then there's no trade. If it gaps down, then it will leave these bars up here in space with a gap up, sideways motion, gap down. This is a very good short-term to long-term indication that we're at a high, and I would potentially short Bitcoin based upon that. DoorDash, which is DASH. Okay, this is called an order block. Here on the 15th of February was an order block. It means that you had a big up bar high followed by a break in structure. Here's the level of liquidity. We went down. We broke that level of liquidity to the upside. Now we have come down strongly, taken out that first pivot point. This shows that the market structure now is down on DoorDash. But an order block is this bar because it's the up bar before the change in market structure. Hope that makes sense. The bottom of that order block, anywhere between the bottom of that order block and the top of that order block here, would be a valid short. So that's what I am looking for. Just if it just pokes its head in there, it doesn't mean I'm just automatically going to take it. I would like to see, a V1 to the downside, a V2 to the downside, but basically in between this line here and the top of this bar and the bottom of this bar, anywhere in this area for me and the way that I trade would be a legitimate short position because of the change in market structure. So it's hard on this podcast to just go ahead and say exactly what it's going to be. I'll basically know it when I see it. But right in here, from the top of that order block to the bottom of that order block would be a legitimate short entry for me. My stop would just be simply a close above this order block. FedEx, FDX. Okay. What I am looking for on FDX is highlighted here in the blue bar. Here's the 300-day moving average. This is a key level. If we get down to this key level, we'll also most likely be in the low 30s, 30 RSI. Remember the confluence of a rejection of a major moving average and a rejection of the 30 RSI. Those two together are some of the best combinations you could potentially get. Now, we're not there yet, are we? And if it doesn't get down here, I'm just not going to take the trade. It's important that you identify the level in advance, mark and say, okay, this level, if and only if it gets to this level, I will consider getting in the trade. If it doesn't, just don't take the trade. But if it does next week sometime get down to this 300, low 30 RSI level, I will definitely consider taking the trade. Microsoft, MSFT. All right, Microsoft is not a legitimate signal yet, but it is forming a return to value. Green line here, anywhere in between here is the value zone. We last week up at the highs we were above the value zone. Now we've come into the value zone. First requirement above the value zone. Second requirement comes into the value zone. It has done that. Third requirement is that you have at least 2 days of sideways motion. That has happened. Now I'm just looking for an entry. What's my entry trigger? Well, a return to value sideways motion, V1 or V2 entry trigger would get me long on Microsoft next week. Qs. All right. Qs on Friday was a legitimate short signal. And why is that? Well, let's talk a little bit about double tops and bearish divergences. Here, over here, January, we made a top. And look at the green MACD bars. This is showing strong upward momentum. Then we pulled back. Last week at the beginning of the week, we were higher here than we were here. But look at the MACD bar, the height of the MACD bars here, not as tall as they were over here, even though we're higher. This is what's called a double top with a bearish divergence, and this is bearish. We also had an RSI divergence. Look at the high here. Look at the reading of the RSI here. Here we're at a higher high here. Look at the reading of the RSI here. It is lower. ATR channels, here we're at the third, fourth, almost to the fifth ATR channel at this level. Here we're much higher, like at 3.5. So we have a triple divergence, bearish divergence, showing that this market is running out of buyers, of buying momentum. And so the implication of that is that we are going to head down. Well, this was a legitimate entry on Friday with the V2 to the downside. Look, Wednesday, we make a high. Thursday, we go higher than that high. Friday, we take out Wednesday's low. Bar 1, bar 2 goes above bar 1's high. Bar 3 closes below bar 1's close. This is a lower high V1 to the downside after a double top with a bearish divergence. One of the strongest signals that I trade. I did not take this trade, but what I am waiting for next week is a move up to halfway of the washout bar. If I were short, my exit would be a close above halfway of the washout bar. I didn't take the trade. I think I may be able to get a little better risk to reward ratio. If we come back next week, touch this halfway of the washout bar and then reject it to the downside, I will get short. My end of day stop will simply be a close back above this line, which is halfway of the washout bar. Let's get to silver, SLV. The metals showed a lot of strength at the end of last week, and especially on Friday. And here we have a market structure change in SLV to the upside. Let me take you through this again. This is something that I teach in my course. Here we have a level of liquidity. We run the level, or in other words, we go below this level, and then we move above the first swing high after the running of the liquidity. Here we have now changed into a bullish market structure. I could have bought it here on Thursday. I didn't. I was waiting for the gaps to be created. Friday, huge day up. But so we are now in a bullish configuration, but it's a little excessive to buy. What I'm waiting for in this trend change to the upside, I'm waiting for a pullback into the gap. The gap is from the high of this bar here, the low of this bar here. I've highlighted this in blue. Any pullback into this blue area would be a buy for me. And my end of day stop on this particular trade would just simply be a close below this low here. If it closed below this low here, then the market structure has changed to the downside. We also have an order block here. A bullish order block is when you have the largest bar to the downside, and then the market structure changes. The high of that order block would also be an entry signal as well. So you could actually move this entire buy area. I can't do it. Why can't I do it? I guess I'll do it this way. You could actually make this entire buy area all the way down to here. So, I trade a lot of options. I probably will sell puts down to this level because it's very unlikely, although not 100% obviously, but it's very unlikely after this strong market change to the upside that it's going to come back lower than this area. So probably next week for me, I'll probably be selling some puts, probably at $20. We're at $21.39. So anyway, but here in this blue area, in this gap or down to this order block, and again, it would be the buy area, but again, I would kind of have to wait and see what the price action is. Maybe a V1 or V2 to the upside would be a good entry point. Virgin Galactic, SPCE. Okay, here, let's see. We had a nice higher low V2. We were below the value zone. We pulled We went back into the value zone. We pulled back. We created a V2. See the V2, bar 1. Bar 2 goes below bar 1's low. Bar 3 closes above bar 1's close. Legitimate entry signal, but it's way too extended. The risk to reward is not good. On a V1 or a V2, what is the end of day stop? It's halfway of the washout bar. Halfway of the washout bar is way down here. So I'm not going to buy way up here and have my end of day stop way down here. I want to buy a lot closer. Ideally on SPCE, if we come down, test halfway of that washout bar there, so like it goes below it during the day and then closes back above it, would give me a great risk to reward ratio. So if that happens and I like the setup, I would buy it in the future. If it just simply closes below there, I'm just simply out of the trade. But this is a very strong level here. And again, market structure has changed to the upside. So more likely this is going to go up than down. But a pullback, it would not be surprising. And really in trading, waiting for a change to market structure, a bullish market structure, and then waiting for a pullback, in my opinion, is the right way to do it. You've heard the saying, buy dips in an uptrend, sell rallies in a downtrend. Well, first you have to wait for the uptrend to happen. The uptrend happened here. We changed market structure to the upside here. Now I'm simply just waiting for a pullback, and it would make sense to me just to wait for a pullback to test this halfway the washout bar, and if it tests and stays above, then I can buy it. It's a key level. If it simply closes below the next day even a little, I would simply get out. But more likely than not, it would probably move my way. But yet to be determined, we shall see. Dollar. Okay, so I was talking about abandoned babies, and we did have an abandoned baby on the dollar. You can see back here on the 12th, the next day we gapped up. Very strong sentiment. Everyone, for whatever reason, everyone was very bullish on the dollar. We moved sideways one day, and then Thursday we gapped down. So we went from being very optimistic to very pessimistic almost instantly. Why? I don't know. I don't follow the dollar that carefully, but something happened. So this is a bearish island reversal. So I'm more bearish on the dollar now. The bottom of that island reversal would be a great place to short. And look, Friday it got right there and immediately came down. I actually just honestly missed the trade. Had I seen that, I would have shorted there because the island reversal, the bearish island reversal, is in place. And therefore, if it got back up to closing that gap of the island reversal, I would get short. And look, the market opened exactly there, didn't move up 1 penny higher, and immediately reacted that to the downside. So that is a key level. Next week, if we head back up, test this level again, I would consider getting short. I'm not going to do it now because it's already pulled back away. The risk to reward isn't that good. But next week, if and only if we come back up to the bottom of this island reversal, I will consider getting short. My end of day stop would simply be it making a new high. That would invalidate. And Verizon. All right, Verizon is working on a potential higher low V2. Here's the value zone, the two green lines. We close below the value zone. We rally into the value zone. Yes, we come down. We almost created a V1, bar 1, bar 2. Bar 2 goes below bar 1's low, but it didn't close above bar 1's close, so it's not a V1. But Monday, and Monday only, by the way, if we close above bar 1's close, which is 40.59, we will have a higher low V2. And then my stop on a V2 is simply close below halfway at the value zone there. So that is what I am looking for on Verizon. The entry, but only Monday, would be a close above 40.59. So hope that is helpful. Let's go over and take a look at the weeklies and see what's going on the weekly bars. Okay, here we are on the weeklies. This is AGQ. AGQ is just double leverage silver. You know, I just mentioned on the dailies, we talked about silver, and then we had the market structure to the upside. I am bullish on metals right here, but I think we've gone a little too far too fast. It doesn't offer a good risk to reward ratio. Look at the V1. Again, these are weekly bars. The week before, this week, we went below the low. certainly close back above the high. Technically, it's a bullish or valid position on the weeklies right here and right now, but I just think it's a little overextended. Remember, halfway of the washout bar, right about here, is going to offer us some good support from a Fibonacci standpoint. So next week, if we do pull back closer to half week of last week's halfway, the green line here or the blue area here, if we pull back, I would consider entering the long trade there. My end of week stop would simply be a close below halfway. Look, again, this is a valid signal. I could have taken it on Friday. And next week, if it goes down a little but doesn't close below halfway, would I be in the right to continue the trade? Yes, I would, because the trade is still valid. The stop has not hit. So if you have a signal and you don't get in and it pulls back, can you still buy that? I do, because the main signal is still valid. All you're doing is getting a better risk to reward. So next week, if we pull back substantially, kind of get close to this halfway of the bar, I would consider getting long AGQ. Boeing. Okay, I've talked about Boeing for a while on the daily and actually on the weekly for weeks, but look, the 200-day moving or 200-week moving average is down here. It's not there yet, so I'm not going to enter the trade. I want to see some confirmation that the price comes down, tests that 200, rejects it, closes back up. For instance, if it did this week, it did not. I'm manipulating this, but if it had done this, I would certainly consider getting along Boeing. Why? Because it went down below the 200. It couldn't find any more sellers down there. And if you run out of sellers, you're going to reverse back up. That's exactly what happened. If it had done this week, I definitely would have considered taking the trade, but it didn't do that. So I'm just waiting for a move down. If it happens, if it doesn't happen, I do nothing. If it does come down, reject that 200, give me a good risk to reward ratio, I'll consider taking the trade. Again, sideways motion. This is 1, 2, 3, 4, 5 weeks of sideways motion. Sideways motion is going to lead to a trend, either one way or the other. Look at the sideways motion we had all the way back here. Same kind of thing, right? Sideways, 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 sideways. Here, sideways, 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 sideways. And did it lead to a trend? It certainly did. So here we are. I'm telling you, this is going to move one way or the other. I just don't know the direction. So I have to wait for some kind of rejection of a level to kind of give me a little insight to what that direction may be. And rejection of the 200-week moving average makes sense to me. FedEx. All right, this is a legitimate, valid trade for me anyway next week, if and only if we get above 242.62. Right now we're at 237.59. Look, the value zone, the green line, we are above the value zone. We come into the value zone. Lots of sideways motion. All I need is a legitimate V1 or a V2. It's formatting itself next week for a potential V2. Bar 1, bar 2 goes below the low of bar 1's low. And next week, if we close above 242.62, that would be a return to value sideways motion V2, and if I do take that trade, my end of week stop will be halfway of the washout bar. Last week was the washout bar. So again, if we close above 242.62, that will be return to value V2 entry. Last but not least is WBA, same return to value potential V2. Here's the value zone, green line, we're above the value zone. We pull back, we have sideways motion, and we almost formed a V1 this week. Bar 1's close is 21.99. Look, we closed at 21.98. Had it closed above 21.99, it would be a V1, and I would have potentially gotten in on Friday. But I follow the rules, not there yet. So next week, any close above 21.99 would be a legitimate entry for a V1, V2. And again, if all of these were to trigger on the same next Friday, I would still narrow it down to the best one. I would not take all of them, only one. And how do I do that? Which one has the best influences on multiple time frames? Which one has the best risk to reward ratio? Which one has the most the best market strength relative to the rest of the market, either long or short. And again, this is what I teach in my course. And if you're interested in the course, please contact me. I would love to work with you. The course is great. 15 hours of one-on-one instruction. Each session is 3 hours, so it's a lengthy session, and then we have 5 sessions, but I take you through all of the different trading strategies. I teach you step by step. I will not let you go as a student until I feel comfortable that you have this and know this like the back of your hand. But like I said, we go through and I teach you each strategy. We do all sorts of simulations, lots of simulation work where we pull up random charts, random time frames, and after you know the strategies, then you show me where you're entering, why you're exiting, or where you're entering, where you're exiting, why you're exiting. I mean, you really have to pass this course before I let you go, but it's a great skill. You'll be a better trader. You'll have a skill for life. And the tuition, which is $1,750, I promise you it is worth every penny. So just reach out to me, email in the link. Now I have an alternative to the one-on-one instruction, which is a video course that I have on udemy.com. It's a great course. I teach you the deep dip buy approach, step by step how to trade the deep dip buy. It's a great approach that is very affordable on Udemy. 9.5 hours of video, 26 videos, 15 study guides. If you're not in the financial position to take the one-on-one, that's a really good alternative. So the link to that is in the link of this YouTube video to udemy.com. If you like today's podcast, I would really appreciate it if you could hit the thumbs up button. It really does help build the channel, helps keep the channel around, lets YouTube know that there's some valuable content. And last but not least, please try to go out and do something nice for someone today. If you can do something nice for someone every day, it's just common sense that it would make the world a better place. And if you could also do something nice for an animal each day, I would really appreciate that. They really appreciate that. I was raised with so many animals, and they like acts of kindness just like humans do. So if you could hit the thumbs up button, do one nice thing for a human, one nice thing for an animal, we'll be square, right? So I appreciate you being here. I hope you have a nice weekend. Please trade carefully next week. In my opinion, the market is on a little bit of shaky legs here. We've had this run up. Trees don't grow to the sky. And, some of the fundamentals and some of the technicals are also indicating that we are potentially going down. So please be careful. All right. So God willing, I will see you next week. Again, down here in Columbia, enjoy it very much. I highly recommend you come down and visit. So, all right, any questions, please leave them in the comment section. And with that, I will run the U.S. legal disclaimer on the way out. And again, appreciate you being here and spending the time. Bye-bye.
U.S. government required futures and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.